Okay, this week's outlook. As always, we will start off with the geopolitics, we'll then go into the calendar, and then we'll do the macro analysis and finish with technicals. So, starting off, last week we continued to see strikes between the US, Israel, and Iran with minimal signs of de escalation. On Friday, President Trump said he's considering winding down the Iran war. However, equities have barely moved off the move, or they did barely move off the announcement, and yields continue to rise, indicating that markets are seeing this as BS essentially, and that escalation should continue for the week ahead, at least until more news comes out. And then this morning, as you can see here, Trump threatens attacks on Iranian power plants if Tehran fails to open the Strait of Hormuz. Now, obviously, the only open market right now is crypto, and crypto fell around $2,000, which percent-wise, I'm not sure if I actually check now. Crypto fell how much off the announcement? Yeah, like 3%, 2.5%. It's still falling now. So obviously a risk on asset like crypto has not taken that announcement very well. So yeah, all this really does is just point to continued escalation, continued strikes, and elevated oil prices, weakening equities, elevated VIX, and stronger dollar. That is literally what this is all signalling to us right now. If we come down to the conflict timeline, we will be able to see that, yeah, everything is pointing to equities lower, equities lower, equities lower, US oil higher, USD higher, and obviously gold higher. However, that's just based off the safe haven. There's a lot of reasons for gold downside, which if you'd want me to go over, whack a comment and I'll reply to it. But yeah, that's essentially where we are at geopolitically. Same as last week. So yeah, let's get into the calendar. So this week on the watch list, it's a lot quieter than last week, but essentially on Monday we've got Japanese inflation. Tuesday we have the S&P manufacturing and services for both the UK and Europe and US, which are going to be very key, because obviously it's a forward-looking indicator, so we'll see what happens to prices, etc. On Wednesday, we've then got inflation in Australia, which is expected to hold around 3.8%, and then we've got inflation in the UK, which is also expected to hold around 3%. Obviously, any ticks higher is going to be a massive concern, because we've now having these elevated energy prices, which is going to bleed into it in the prints down later on. So essentially, yeah, very important prints, and you could see short-end yields react very sharply off this. And then on Friday, we've got retail sales in the UK, which is expected to contract to minus 0.04%, which is horrendous. So yeah, that is essentially the week ahead, what we're looking at for the calendar. Now let's get into the macro. So, starting off with the US. Flows should remain in favour of the dollar as the war continues, and as we see oil prices remain elevated. Short-end yields received a nice push to the upside last week following the more hawkish FOMC meeting, as you can see here. A very hawkish meeting, 20 basis points to the upside on the 2-year, just supporting dollar strength for now. And the strong PPI prints at the start of the week as well. For the week ahead, the main data points to be watching are going to be the PMIs, which will give a good indication on how these US oil prices are getting priced in to the data. And as always, take it day by day and headline by headline, as one tweet from Trump can flip the escalation narrative on its head, as we saw yesterday and then this morning. Insights-wise, we will see Bank of America. The whole narrative right now for the US, or for the Fed at least, is we've gone from pricing in rate cuts to now rate hikes. So Bank of America are saying, this is obviously dollar bullish, they're saying, what Fed cuts, let's talk about hikes. And then ANZ are moving their calls, so they delayed their call from September to now June for the next rate cut. So obviously, hawkish repricing, which is going to be reflected in a stronger dollar. So yeah, that is essentially it with the dollar this week. Sentiment remains very risk off. Data seems to be sticky, and yield reactions are pointing more hawkish, with the institutions more bullish on the dollar. Seasonality-wise, March is a pretty neutral month for the dollar, and yeah, that's really it for the dollar this week. Bullish on the dollar. Onto the pound. We remain bearish. Obviously, we know last week the pound found a good footing last week due to its rising yields and massive repricing in the short end of the curve, which in my opinion isn't actually going to materialise, meaning I think all these rate hikes were getting priced in. As soon as there's any sign of de-escalation, they're going to be priced out, and you're going to see the pound weaken, you're going to see the CAD weaken, you're going to see the dollar weaken. So yeah, that is essentially my thesis there. However, as long as energy prices remain elevated, we will see this reflected in short-end yields, meaning obviously we're going to see the GB 2-year very elevated because of energy prices. The key data next week for the UK is CPI on Wednesday and retail sales on Friday, which will be key in the current environment as inflation in the UK is already at the top of the Bank of England's target, being 3%. The markets like the Bank of England's rate hold last week. However, we expect markets to fade this throughout the week ahead. So yeah, pound downside on specific crosses. It is very important to mention that everything is specific crosses. So you'll see on the technical section why we're taking, for example, GBP CAD or GBP USD, but not Euro Pound. That's why it's very cross dependent. Moving on to the Euro. So for the Euro, we remain bearish. Obviously, ECB rate hike expectations are gaining traction in markets with growing speculation that tightening could begin as early as April. I mean, major institutions like Barclays Bank, JP Morgan are now forecasting an initial move next month, so they're looking for an April hike, followed by additional hikes in June and July, reflecting a rapid shift in policy expectations amid rising inflation risks. It is evident from last week's meeting that the market for now is a fan of the euro due to rates. The market is preferring the rate hike narrative from elevated energy prices hurting growth, essentially. You've got two narratives here. You've got, all right, we're going to have extremely high energy prices, which is going to bleed into elevated inflation, which means the ECB is going to have to hike. That's one narrative, which you could argue is good for the euro. But then the other narrative is energy prices are so elevated, there's going to be a cost of living crisis, growth is going to be harmed a lot. I mean, even if you look at like the Swiss National Bank's meeting last week, they slashed growth forecasts. So in one way you've got, it's good for interest rates for the currency, but then on the other hand it's bad for growth and productivity, which could be bad for the currency. So it's a double-edged sword, and you just have to play with what's driving the market, which right now is rates. However, we think this will probably be faded on specific crosses. So, for instance, we're looking like Euro CAD and Euro Dollar will be looking for downside. However, we'll be going long on Euro Pound, Euro NZD, Euro Yen, that sort of thing. So yeah, that is the Euro. Obviously, you can see here in the insights, it's very divided at the moment. You've got Goldman Sachs, who are convinced on a lower Euro Pound, whereas you've got SocGen, who are convinced on a higher Euro Pound and a short GA. So when the institutions are conflicting, the smart thing to do is leave it and trade other crosses. But yeah, that's essentially where we're at. Data's been pretty hawkish for the most part, yield reactions at least. Canada. So for the CAD, we are bullish on the CAD. As you can see, the recent news here is all pointing to a bullish CAD. Obviously, it's very oil dependent at the moment and aligned with the US dollar, so we should continue pushing higher. However, price action over the last week at least has been an absolute roller coaster. For me, I prefer to express my oil speculation or elevated oil prices through the Norwegian krone, as it, for one, is not linked to the US dollar. So obviously, you could have elevated oil prices, but the CAD could weaken because it's so linked to the US dollar. So like, if the US dollar is doing terrible, that's what we mean by that. However, the Norwegian krone is obviously not linked to the dollar or not mapped to the dollar as much as the CAD, and is has a decently high base rate. I believe it's 4%, which means it's appealing on the carry side of things. It's appealing on the oil side of things because it's a net exporter and it's got quite a lot of supply. So yeah, NOK upside we prefer over CAD, to be honest. But yeah, I mean, with minimal data releases this week, all eyes are going to be on the headlines coming out of the Middle East as usual, and whether they point to continued escalation or de-escalation. So yeah, we'll see what happens there. But essentially, a lot of the institutions bullish on the CAD, MUFG, Bank of America. The recent news from Bloomberg, Reuters is all pointing bullish. And obviously oil being elevated is going to support it. So we do foresee CAD upside. Moving on to the Australian dollar. Similar thesis where we're neutral. Equities and gold's decline continues, which should limit the Australian dollar's gains. Saying that, the RBA's hawkish stance last week has definitely supported the front end of the curve, and with inflation data this week forecasted to remain quite sticky around 3.8%, it provides an additional confluence for Australian dollar longs, from a rate differential standpoint at least. So yeah, I mean, that's kind of where we're at with the Australian dollar. We're neutral. We think there's cleaner crosses out there. New Zealand dollar, we're bearish, same as last week really. Equities are falling, showing the divergence away from risk on to risk off. The VIX is very elevated, and New Zealand is a big net importer of energy. So this should divert money, or flows at least, away from the Kiwi. The Chinese yuan depreciating will also put downward pressure on the Antipodeans, as obviously the Australian dollar, the New Zealand dollar, a lot of traders trade them as a proxy for China, and if China is going to be harmed by the massive energy imports, we can then understand why the New Zealand dollar is going to weaken off, why the Australian dollar is going to weaken off, that sort of thing. So yeah, bearish on the New Zealand dollar. Japanese yen, we are bearish. Same narrative as last week. Japan are essentially a mass importer of energy / oil. Last week's Bank of Japan meeting was more dovish than expected, which from a rate differential angle supports downside as well, and we're still seeing an elevated long end, so it's all pointing to downside. However, you do have to be careful of intervention risks as we approach the 160 handle on UJ. Swiss franc, we are actually bearish this week, and pretty simple. It's the correlation to gold. Gold is having a terrible time. We're back down to 4.5 thousand an ounce. And yeah, that's going to really, really pressure the Swiss franc, not to mention last week's SNB meeting being very dovish. So yeah, that's essentially what we are seeing macro-wise this week. Now, moving on to the technicals. If we go here, so yeah, starting with the DXY. I like longs from this level here. We obviously had a lovely reaction off the 99 handle. I think the 99.25 is the next stepping stone for higher prices. And I believe, once we break past this level, I'd say we could even target a 1 to 2.6, 1 to 3. This is what I'm looking at on the DXY. Obviously, this is given that we continue to see escalation, but that's what I'm looking at on the DXY. GU, basically the DXY inverse. I'm looking for shorts from this level here. And yeah, I like this level. I think this level makes a lot of sense. GCAD, similar thesis. Price action is not as clean, but I'd want to get in probably around the 184. So if I mark the 184 out, I'd probably want to get it in around here. But yeah, price action is not really telling me much. GA, we're kind of already in this key level, so I'd ideally want to see a weaken off from here. If we break above this level, I'm going to be hands off, just because I don't really like the price action to the right over here. If we go on the 6 hour, yeah, this is kind of the only level I'm liking. Saying that though, we could get something off the 1905, but it is a weak versus neutral, so there's definitely better crosses out there. New Zealand dollar against the US dollar, I want to get shorts from the 586. If we place that there, I'll be looking for something along these lines, something like that. NZD CAD, same thing here. I want to get shorts off that 0.805. AUD NZD, I think this could be a lovely position. If we go on that the daily, covering the 1.2, it does make sense. I think this is a nice position, but we could get tapped in off market open, which is annoying. But if not, I'll be looking to get in on London session Monday. Dollar yen, it's annoying. I took a loss this week on dollar yen, but I want it to come back down to this level here. I don't really want to mess about getting in on these weaker levels. AUD yen, neutral versus weak. If you want to get in, probably something along here. Yeah, something like this would look nice. But looks nice. Do the fundamentals follow it? They do kind of, but there's better crosses for sure. So yeah, something like that on AUD yen. CAD yen, similar thesis to dollar yen. I want it down there. Euro CAD, a rejection from this level would be very nice and would make a lot of sense. CAD Swiss, I'm eyeing up these two levels. So if we don't get, this looks like it will be a market open play, which is annoying. But if not, this level down here looks very nice, very discounted. USD Swiss, this level here, obviously it looks quite extended on the 1 hour, but yeah, I like this demand zone. Right on the 7825, so I'll probably get on the 7825 around there. Something like that looks very nice, especially with gold's weakness as of now. And until the fundamentals change, we can expect to see gold weakness persist. So yeah, something like that. GNOC, I really like this level here. I really like that level. EuroNOC, similar thesis. Something from this level here. We managed to catch a nice position there on Wednesday, but this level here is what I like to see. Euro AUD, obviously this is a higher time frame position. I'd probably be taking this on like the 12 hour. But yeah, something like this for a 1-to-1 does make sense. Just from the energy narrative, and you've now also got the rate differential narrative. I mean, you could argue it's playing in both hands, but something like that. AD Swiss, a bounce from here is very, very, I'm not going to say risky, but I do like the look of it. But yeah, you have to be careful for sure. And I believe that's everything. Yeah, those are all the technicals this week. So yeah, this is essentially what I'm looking at macro-wise and technical-wise. Yeah, not much else to really add there. You just have to take it day by day this week and be very careful. But yeah, that is essentially the outlook. As always, drop a comment with any questions. If you want to ask about why gold's been melting, drop a comment. I'll reply. And yeah, that's everything this week, and we'll catch you in the next breakdown.